Are we rocking and rolling?
Looks like
It's still not live yet. So I don't know what's going on.
Okay.
There we go. Welcome everyone to Name Confidential Live.
Hey, welcome back, everyone. Branden DuCharme, one of the hosts for NAAIM. And today we are joined by the brilliant John Kosar of Asbury Research. John's got some really interesting work he does with research, something that I've been a little bit more familiar with, and have followed a lot of his market commentary pieces. He's got some really interesting insights, and we are going to jump into that. Just as kind of a call out or highlight, the name exposure index is at 91.33. So I think it's safe to say that post-election here in the seasonality strength, I think a lot of active managers are picking that up and have some pretty strong long positions in equities relative to the kind of trend in the past. Last quarter's average was only 80% exposure, or 80.82 was the exposure index, and we're at 91.33. So John, maybe like what I'll do is open up by saying active managers are pretty, I mean, they're exposed, they're in the markets, right? We have the equity exposure on as a subset of the demographics. How does that line up with what the work you're doing at Asbury is kind of telling you, or you guys are observing?
Yeah, we've been our CPM model, correction protection model, CPM. That's our risk on and risk off model. On average, it moves about 5 times a year, so a little bit slightly more active than once a quarter. That initially moved back into the market on November 3rd of last year, and outside of two very short periods of risk off, and if it's risk off, when we're managing money, what we do is we go to BIL. You're probably familiar with BIL.
Sure.
It's a short-term interest rate ETF. So we really look at CPM as kind of a dynamic stock and bond allocation instead of the typical, well, you're 65 years old and you want to retire in 3 years, and your risk tolerance is X, so you're a 60-40 person. You're 60 stocks and 40 bonds. I've never thought that made a whole lot of sense. And we use the CPM and let the market tell us when to allocate. But where I'm going with that is outside of maybe let's call it 6 weeks. Outside of 6 weeks, we've been risk on since November 3rd of last year, and we're risk on now. The last move in the CPM was on August the 15th when we went back to risk on.
Okay. And so that sounds like a pretty slow moving, indicator, if you will. Like I don't know if that's a fair assessment of it, but it's not very active, right? It's not
No, it was built to be that way.
Yeah, it sounds like it's more of like a trend following, indicator, not so much, mean reversion. I'm sure you have way more work built into it than, a general thesis here, but what about, like I've listened to a lot of your market commentary on the Asbury 6 in the past, and so you have kind of 6 different data points that you look at to try to test and understand what the market is doing internally, is the way that you've described it, right? And kind of gauges what you would call like the health of the market, and produces a kind of a bellwether of where you're at in kind of a risk environment that way. Tell us like a little bit about that. What are the 6? So if we talk about like the Asbury 6, what are the 6 data points that you feel give any kind of lighter indication to like what you call the health of the market?
Yeah, let me go back one more step and kind of talk about why we built the Asbury 6. I've been doing this for 40 some years. First half of my career was on the trading floor of the CME in Chicago. But what I had noticed over the past decade, the markets got progressively choppier intraday. There was more and more of those days where you get up in the morning and the market's down 50, and you're looking at all your charts and thinking, what did I miss here? And then by the time it's lunchtime, it's up 30. It's very easy, even when you've been doing this as long as I have, to make mistakes when you're getting that kind of just choppy noise during the day. So Jack and I, Jack's my son, who's now my partner, and he'll be the legacy for the business when I'm 102 and then decide to hang it up. But we started taking all of the tactical tools that I had used throughout my career and starting to back test them as sets of 3, sets of 5. It could have been the Asbury 3 or the Asbury 8. We found 6 that work really well. We all know, right, that every indicator has an Achilles heel. You could always tell when somebody's kind of a novice at this, because they say, John, what's your favorite indicator? And for me, there really isn't one, because they all have an Achilles heel. There are all indicators that I've ever come across. There's no magic one. So we found 6 that do really well. I kind of equate them to a hockey team of 6. If your winger falls down, your center might come to pick up his check. That's kind of how these are supposed to work. If one or 2 of those indicators fail, you've got 4 more, and they're disparate enough to where there's not a lot of crossover. So those 6, we look at the rate of change in the S&P 500. We look at volatility. We look at asset flows in the spider. We look at market breadth. We look at relative performance between stocks and bonds. And I know I'm missing one here, and I should know these, right? But like the back of my hand. But give me a second so I can. I look at these as a unit, so I don't even really pay that much attention to them individually. But those 6 are, just rattle them off here: rate of change, relative performance, stocks and high yield bonds, investor asset flows, volatility, trading volume, and market breadth. So the way it's built, it was built to be an indicator. Now we've back tested it as if it was a model, buying when 4 or more of the 6 are positive, or actually on the metric. You've seen the metric, they're green, and it shows the date that it turned positive. 4 or more green, we're in SPY. 4 or more red, we're out of SPY. It's very active. It's opposite. The CPM has modules in it that keep it in the market as long as possible. We want this to be jumpy. It's like an EKG for the market. So this thing actually goes from positive to negative 11 times a year, so almost once a month. But where this has been really good is the maximum drawdown during the past 7 years in the S&P 500 was 34%, and that was during COVID. This has been 13.7. So it's really agile in getting out of the market, but it's really busy. So I don't trade this. I never use this to make a trade. I use it to put where we are on the price chart into some kind of context that has to do with the internals of the market.
One of the internals that you sort of talked about there, like one of the indicators, stocks, the relative performance of stocks versus, you said high yield bonds.
Yeah, we look at, I think for this indicator, we look at junk, JNK.
Okay.
So there's a couple. There's HYG and there's JNK. They're cousins. I think they're different originators. I'm sure they're different originators, but for this one, we use junk, JNK.
Okay. Why junk, and what's your thesis on why the relative performance would indicate a risk on or risk off environment potentially?
When stocks are outperforming high yield bonds, that occurs when the stock market's in favor. when stocks are underperforming high yield bonds. It typically happens when stocks are out of favor. So we've done linear correlations on this. It's been so long since I've done this, but we did a Pearson coefficient, just a simple linear correlation on the two series, on SPY and on that relative performance line of SPY versus junk, and it's a reliable indication of what kind of risk appetite there is in the marketplace.
Okay. I guess like in my simpleton brain, I'm trying to wrap my head around. People always like I hear financial planners or allocators will say, high yield is a risky place to be because you get this yield, but you're taking on a risk like a stock. They have these equity like drawdowns. And so to me, I'm sort of thinking like I would anticipate if you just said, Branden, tell me, stocks versus another asset class and determine what's kind of in favor. I would have said probably maybe corporates, but more so maybe just something like the ag, right? So like relative performance of S&P versus the ag. And so I find it interesting that you guys have it be, high yields, when traditionally people would think that's like still a pretty risk asset.
Well, because they're both so similar, and
Okay.
they're high yield bonds trade more like an equity than they do an interest rate. So I think maybe the reason that it works so well here is because the relative performance between two things that are more like each other, right? So that sensitivity might be a little bit more. You're taking a lot of the interest rate, how an interest rate acts out of that equation and making it more like an equity. But we do look at SPY Ag. I mean, that's a great indicator that we look at to tell us the same thing. Stocks over bonds, SPY Ag. So I'm sure that all of those relationships are very similar. SPY Ag or SPY Junk or something like SPY Corp, versus what is it? Corporate is what is it? LQD is the corporate ETF. I'm sure they all are really close to each other, but through our back testing, we found that this one, for this particular metric, it worked better. It just back tested better.
Okay. Is this something that you started to come up with at all when you were on the exchange floor? Like, I mean, that's a fast-paced moving environment that I would think you kind of have to have a really good feel or gauge of what the markets are doing, you start developing this kind of thesis there?
Well, yeah, I mean, so I started down there when I was 24. I was a little bit older, believe it or not, than a lot of the kids that went down there to work. A lot of the kids went down there to meet girls and go to parties, and I was already 24 years old. I mean, it was 3,000 young people all on this giant football field of a trading floor every day. I went down there because this is kind of what I wanted to be when I grow up. And I was really serious, and I used to draw my own charts. When I was a bachelor, no one was allowed to put any food or beer on my kitchen table because that's where my hand-drawn charts were. It was like the shrine, if anybody went near there, they had me grabbing the back of their shirt and pulling them off. So I really got into this from I was probably down there. I spent a lot of time in the library at the CME just reading and learning. So I started a little chart service on the trading floor, just supplying floor traders with support and resistance levels and just a few ideas. I used to scribble them on the back of a trading card, and before you know it, I had 50 guys that were paying me a monthly fee to do this. And a lot of those guys were really smart. They were like old grizzled guys that have been down there for 30 or 40 years. And I made actually one of my closest friends, he's been dead now for about 10 years. but I met him. He was one of my customers, and he was a soybean trader, and the guy was brilliant. And I learned so much from him. So yeah, a lot of I think I got a kind of a retro rockets kind of effect on my learning process because I was around so many smart people.
What I always hear this stuff about like support and resistance doesn't really exist in the market. It's just, it can't markets can't be timed and whatever. And obviously that all comes out of the people that are, efficient market hypothesis, modern portfolio theory. And you have serious, significant experience around this. And I've heard a couple times now you say like, this experience around support and resistance, or, prior to us starting recording today, you were telling me that, when Asbury 6 is kind of split, 3 indicators risk off and 3 indicators risk on, you find that typically coincides with a level of significant support or resistance in the market. Like, how do you feel that this support and resistance theory has impacted your trading over the years, or your ability to work in the markets? Like, is it an ability to time an entry better? Is it the ability to harvest profits better? Does it provide just, like more clarity, or when to stay out? How does this affect ability to make money at this whole game?
It's a really good question. Support and resistance levels are, in my world, they're imperative, because everybody knows that the market goes up most of the time, right? If you look at a 100-year-old chart of the Dow, outside of put within the context of that 100 years, it doesn't go down very much. So the game is not whether I should. The big difference for me, when I was on the trading floor, I started with the commodity markets, and then I moved over to the S&P 500 a little bit later in my stay down on the trading floor. But instantly, especially after I got off the floor and I started to work for a couple of firms off the floor, and then I launched Asbury Research in 2005, it was easier for me to make that transition because the stock market has an inherent upward bias to it. It goes up most of the time. So where I might differ from other market technicians or data-driven types like myself is, early in my career, I started with price, right? I would look at the chart of the S&P first, and I would say, where's the trend lines? Where's the moving average? What's the stochastic doing? That was the first step. Now, looking at the chart is the last step that I do. First thing I want to know is, are the internal market conditions conducive to going higher? And we actually, Jack has been an enormous help in that way. But we run scans at 5 o'clock in the morning where we're scanning 6,500 ETFs and looking for ETFs that show certain criteria that may have to do with relative performance or asset flows or half a dozen other things. But we've got scans that we've built. So we scan these 6,000 plus ETFs. And then when I begin my day, I've got a list of ETFs, from our scan. Sometimes there's 20, sometimes there's 5, sometimes there's 35 or 40. Lately, that list has been expanding. There's been more and more that have been hitting the criteria, which is why I've been bullish all week. I saw this more opportunities showing up in individual ETFs. But where I was going to answer your question is, the last thing that I do, I might have 10 ETFs. I did this morning. I had 10 ETFs that all met those, let's call them quantitative screen that we did. So they met all of those, checked all those boxes. The last thing that I do before I put that trade on is I look at the chart as a guy with 40 years of experience that knows how to read a chart, and ask myself, which of these do I have the most risk reward to trade? Some of these might be underneath an old high from 2 years ago. I'm not touching those. You never ever buy into resistance because your risk reward is upside down before you even get the order in. I might look for something that's sitting on a support level. So I'm risking this much to make that much, or maybe something that just broke out of a pattern. But that's the only subjective thing of what we do is I'm the final arbiter. Where's the risk reward? And that's what I did for 17 years on the floors. Where do you buy the S&P? So you could, I might have had an order on the floor. John, I want you to buy 500 S&P contracts between now and Friday afternoon, and it's Wednesday afternoon. So I have 2 days to try to put these trades on at the opportune levels and use charts for those. So that's kind of where I've evolved or changed as someone that's been doing this for a while, is now the chart and subjectively determining where the risk reward is the last thing I do. That chart is not the first thing I do.
When you're looking at levels of support and resistance, you feel like you're finding something on a breakout. What have you found the most effective measures are to limit your risk in that trade? Do you use like an ATR band with a stop loss? Do you even use stop losses, right? Like how do you manage your risk going into a trade like that on a breakout?
Great question. I don't know that you can use hard stops anymore. That's my own opinion because there's so much intraday volatility. And I think a lot of these, some may call me a conspiracy theorist, but I think a lot of these algos look for these levels and get you knocked out. How many times did you put a trade on? It comes out and grabs your stop. And then 3 days later, it's making a fresh high and you've got to buy that. I saw guys doing it in the pit in the 1980s where 4 or 5 locals, the locals were the guys who owned their own seats that were taking the other side of the order fillers. The order fillers were at the top of the ring, and then down in the bottom were the locals, and they were there to provide the liquidity. Well, they were there to put another Jaguar in their driveway is really why they were there. But I saw those guys would have an idea of where the stops might be. And 4 or 5 of these guys who didn't really know each other, they were, with a wink and a nod, they'd all sell at the same time, push the market down to that level where they were pretty sure that there was hundreds of stops. Once that price is hit, let's say you're in the live cattle pit and you're trading at 65.60 and you think that there's hundreds of stops at 65 even. If you could push that down with 5 or 6 or 7 guys, 5 or 6 or 7 millionaires in the pit, push that down to 65 and somebody calls out 65 trade, all those 300 turn to market orders. They got to sell 300 at the market. That may drive that thing down another $1. Those guys buy them as soon as they feel the exhaustion down at the bottom, and now there's no locals in the pit after 11:30. They're all at the Cub game because they already made their money. I think so. Long wind up to give you an answer for that, but the answer is I still think a lot of that is going on now with some of these algos. So I use soft stops. Our models don't have stops. They have like CPM or our CEF model, which is a sector rotation model. They don't have stops, but they have a sleeve, a module built on them. Say there's a systemic issue. Let's say somebody drops a bomb and blows up the Capitol building, whatever it might be. There are emergency situation modules on those to make sure that if it exceeds certain things, we go to cash immediately. We're in cash. But for my individual trades, like I bought IYT today. The reason, and that's the Dow transports. That I want to buy the Dow transports in a time where technology is rocking? Absolutely not. But that's what our scan showed of this quantitative scan that we did. And I had some risk reward there where I could risk 3 or 4% and have open-ended upside with a big support level underneath me. So do I have a stop there? Yeah. Is it a hard stop? If it comes there, if it goes to that stop, a bell rings in our office, and I'm starting to look at that chart all day. Anecdotally, 8 times out of 10, it goes a little bit underneath that level, which is not magic. It's like an old low, or it might be a trend line or something that anybody can see that's been doing this for more than a day and a half. But I will let that sit there and let the market tell me, usually by the close. If it falls through it by the close, I'm out of there, and I lose 3 or 4% on the idea. But we've got, on these ideas that we've picked, we've got 80, they're individual trading ideas. We have a lot of our clients who like to be shorter term traders. I'm really not a shorter term trader, but these trades, there's 80 of them over 20 months. 57% of them were profitable, and the average profitable trade is 2.5 times bigger than the average losing trade. And we use soft stops for those. I'm not going to put a resting stop in the market. If that stop is approached, I'll watch it and use my discretion. And hopefully I've learned something in doing this for 40 years. And anecdotally, 8 times out of 10, it ends up turning around, feeling around down around the stop area, and the market turns around and goes the other way, and I'm still long.
I'm not sure how to help you with that.
I think like one of the things I've noticed recently as I've been looking at charts the last, it feels like the last several years it's happened now, but especially the last, this last year even, so there's just a lot of V-shape, and granted, I wasn't doing this in, coming off the bottom in 2008, right? But like that quick violent drawdown and then an equally violent recovery, and that's popping, it's showing its head, that level of volatility. So like, even though in options contracts the implied volatility moves in the options, the VIX and all that has come down, the actual, I think, like volatility, the realized volatility is almost up, where you get these quick violent drawdowns, equally violent recoveries. It's like, that's a lot of volatility. And I don't know what that's from, but it sounds like you're kind of saying there's the same thing. And the market it's like, what's the old saying? The market has the propensity to make the most amount of people look the most foolish at any given time, and so it's like,
Well,
violent drawdown gets you out of your, hit your stop losses, shake them all out, and then recover right back.
my theory on that, again, is that the arena for the game has changed, right? It used to be in the pit, and now it's on all of our screens. The game hasn't changed, though. I think what those locals were doing when I was 26 years old in the cattle pit, that basic game is still there, but now it's being done with a lot of computers. It's being done with a hell of a lot more money, and it's been doing and it's more stealthy. The identities of these participants isn't as obvious as it was back in the day, when I was on the trading floor. So I believe that there are algos that capitalize on that. I call it financial jujitsu, right? They get you leaning one way, and then they throw you on their back, when they turn the other way. I think that happens all day long, and I think that has taken the effectiveness of using a hard stop, putting your stops in, and damn the torpedoes, wait for the thing to work or not. I don't think it's that easy anymore. I think, at least for me, my level of success has exponentially gone higher because I don't use hard stops. I don't use specific stops. A bell goes in my office, a screen lights up, and now I've got my eye on that thing all day long. And again, anecdotally, most of the time, with a little bit of patience and a little bit of experience, I had a really good idea, but I didn't get shaken out like I would have if I would have used that hard stop.
Is that like for the people out there that say, trading or active management for long-term investors is a silly game, just buy and hold, a broad market index fund and just, it just goes lower left, upper right over time if you just hold long enough. Which I think it's hard to beat a benchmark that's fully invested all the time. But where there's this high frequency, like, what do you say to that? Is that where, something like CPM that's not quite as active is you're just trying to change the profile of like risk return, or what's the, how does somebody win this game as a longer term investor, as compared to, because that's a different game than being a short-term trader on the, commodities floor, right?
Yeah, I'm scribbling some notes down because you hit several nerves as you were. Very good questions. A lot of pet peeves of mine. When I hear some guy in a $3,000 suit on CNBC say, "You can't beat the market," what I'm hearing is I can't beat the market, right? So I don't. So these guys have something to sell here, and they're not timers. Can I time the market all the time? No. Can I time it most of the time? I can. I've been doing this for 40 years. I'm good at it. There's a lot of guys like me. I'm not the only guy. But when I hear somebody come out and tell me, "Don't even try because you can't do it," he's talking his book. That's what he's doing. He's saying, "I have no clue on how to time markets, so I want to sell you on my buy and hold. And you're 65 years old, you have 3 kids, you want to retire and buy a horse farm when you're 70, and your favorite color is blue, and your birthday is June 24th. So you're a 65-35 stock bond man. You get an electric birthday card on your birthday, and that's the deal." I don't think that makes a lot of sense to me. Now, I have 2 boys that are actually about your age. I think Jack's a little older than you and Brett's a little bit younger than you. But for somebody like that to say, "I'm going to be a buy and hold guy. I'm going to buy some technology. I'm going to buy some whatever, high beta stuff." And you can sit on that for 20 years and you can build yourself a tremendous foundation for yourself. But once you get, in my world, once you get into your 50s, the game changes. And it's like, the best analogy that I can make is football, right? When you're in the first half, you can throw some bombs, you can do some plays where you're handling the ball behind the line of scrimmage and your likelihood to fumble is much more. Once you get in the fourth quarter and you got a lead, game changes. You give it to your big fullback, you have him wrap his arms around it, and you eat the clock up. I think investing is like that. Once you get to that age, and I'm way above that age, and this is how I invest, I don't want to fumble the ball with 5 minutes left in the quarter after I've worked my tail off to have a really nice lead. That's where, so age is the thing. Buy and hold is fine when you're 30. I don't think it's very good when you're 50. Certainly not very good when you're in your 60s. And the thing about CPM and why it's so popular, CPM going back 7 years, and I think you've seen CPM before. It has stuck like glue to the S&P 500 over the past 7 years. Jack and I have made some revisions over the past couple of years that have made it better. It trades less and the performance is better. But basically, and not sitting here trying to sell my product because I'm not, but why would you do a CPM? CPM has been right on top of the S&P or a little bit above it or a little bit below it for the past 7 years, where we've had 100-year pandemic. We've had a Fed-induced crazy uptrend in 21. We had a major downtrend in 22. We went from a zero-rate interest rate environment to a more normalized environment. A lot of stuff. It's a robust 7 years. It stayed right with the S&P that whole time, but the maximum drawdown during that period is 20%. The S&P was 34%. standard deviation is about half. The beta is like 0.55 or 6 compared to 1, and the Sharpe ratio is way better. So for somebody that's my age that says, man, I want to play the game, but I can't white knuckle these 50-point openings up and down, how can I play the game with less risk? The CPM is one way that they can do that.
It's some type of tactical timing model that can take your chips off the table for you, basically, when it's just not favorable to be invested, is sort of what I'm hearing.
Yeah, and the other thing is, as you get older and you're starting to draw from that money, the size of your drawdown becomes especially important. Keeping that drawdown at 20% instead of 34 is a huge deal, because you're also drawing off of that money every month or whenever you're taking your distributions. And the other thing too is smaller drawdowns mean that you can get back to that old peak in equity, open trade profits, if you will. You're able to get back there faster, right? Because you don't have so far to go. So there's a lot of advantages that are more built for I'm an older investor. Most of my clients are not your age. They're more my age. It's just natural, right? You're going to attract guys like you. And Jack is going to attract guys like him. And as you go through your career, I think, your dad's probably the same way. A lot of the guys that he knows are probably from his generation. And, but for the people that I deal with, that's what they're looking for. They want to play the game with less risk.
Well, I always like the idea of getting the same kind of result with less risk, but I suppose you never can get truly less risk. It's just transferred, and you can transfer it to a risk you're more comfortable with, I suppose. It's sort of the way I look at it. Well, I think we probably ought to wrap it up. I really appreciate your time coming on as a friend of NAAIM, and giving us some of your insight and wisdom, John. It's not lost on us, and we appreciate it as an organization, as other active managers, as other active allocators, and we appreciate you taking the time and sharing what you know.
I was happy to do it. I hope there was something in there for everybody. Thanks.
Yeah, we'll talk to you soon, John.